Professional consensus surrounding the 2026 AI boom has fractured into two extreme camps. One side argues that current valuations are a mirror image of the 2000 dot-com bubble, fueled entirely by speculative mania. The other side maintains that because AI adoption is generating real-world revenue and massive free cash flow, today's market valuations are sustainable. Both interpretations overlook a deeper reality, blinding markets to a different and more dangerous form of systemic fragility. The 2026 AI boom centers on a massive physical capital expenditure cycle. This cycle depends on industrial assets, advanced semiconductors, hyperscale data centers, and the high-capacity energy systems required to run them. Unlike the startups of the late 1990s, the firms controlling these assets possess some of the strongest balance sheets in financial history. However, high profitability does not eliminate bubble risk. It simply shifts the location of the potential collapse.
The actual threat is a prolonged period of large-scale capital misallocation, followed by a brutal compression of market valuations. While the AI revolution is a technological reality, the capital structure supporting its physical build-out is becoming unstable. To understand this instability, we have to look at the structural differences between the current cycle and the internet boom of the late 1990s. The 2000 bubble relied on the promise of digital abundance. Markets overestimated how quickly infinite digital real estate could be monetized, leading to a NASDAQ collapse of nearly 78%. Countless firms vanished because they lacked durable revenue, earnings, or any meaningful competitive barriers. The 2026 AI boom is different because it is strictly governed by physical scarcity. Expansion is currently restricted by real-world bottlenecks: electricity generation, grid infrastructure, and advanced semiconductor packaging. Economic law dictates that whoever controls these physical bottlenecks commands significant pricing power. This dynamic creates durable, oligopolistic structures among hardware and energy providers that did not exist for software startups in 1999. Because today's megacaps control these essential physical assets, they are shielded from the total extinction seen in the dot-com era. With physical bottlenecks and real profitability providing a higher floor for valuations, a 2000-style collapse is unlikely. To find the real systemic risk, we must analyze the spending habits of the hyperscalers. The mistake many investors are making is assuming that today's peak earnings and margins in the AI sector are permanent. Historically, speculative peaks are defined by temporarily inflated margins that lead markets to over-extrapolate future growth. This graph tracks the massive infrastructure overbuild currently underway. The steep rise in compute expansion and capital spending has pushed margins to a temporary peak that may be unsustainable. The current market assumes that enterprise adoption will accelerate indefinitely to justify this level of hardware investment. If software monetization slows, hyperscalers will likely slash spending on data centers and GPUs. At that point, hardware valuations will reprice violently. This pattern of capital destruction following an infrastructure overbuild is a historical constant. During the railroad expansion of the 1870s, the physical infrastructure changed the world, but the overbuild bankrupted the investors who paid for it. We saw this again with the late 1990s fiber optic build-out. The technology succeeded, but misallocated capital led to years of disappointing returns. If hyperscaler spending contracts, the resulting correction will not be a technological failure, but a massive destruction of investor capital.
The phrase AI bubble is misleading because it ignores the internal structure of the market. Risk profiles are stratified based on where a company sits within the AI supply chain. At the base are the infrastructure monopolies. Their control over scarce physical assets provides the most stability, though modeled drawdowns for these firms still range from 20 to 45%. Hyperscalers occupy the second tier. They have massive cash flow, but they are vulnerable to their own capital spending cycles, facing a projected risk of 25 to 50%. The danger increases sharply at the software and application layer. Because software is easily commoditized, these firms lack the hardware floor, leaving them exposed to modeled drawdowns of 50 to 80%. The most extreme risk sits at the apex, speculative small caps. Lacking both earnings and physical infrastructure, these narrative-driven stocks face near-total wipeouts of 70 to 95%. The foundational hardware layers are protected by scarcity, while the software apex is uniquely fragile. The AI revolution will continue, even while large portions of AI-related market capitalization are decimated. The Kondratiev wave framework helps explain why these cycles of euphoria and consolidation repeat. Capitalism evolves through long waves lasting 40 to 60 years, each driven by transformative infrastructure. The speculative excess today represents the late-stage climax of the fifth wave, built on information technology. However, this current infrastructure build-out is the bridge into the emerging sixth wave. This new era will be defined by the integration of robotics, intelligent energy systems, and autonomous industrial automation. Crossing from one wave to the next is historically brutal. Past transitions have required massive capital destruction to clear out speculative excess before mature adoption could begin. Markets are currently overpricing the speed and the ease of this transformation. This phase will likely feature prolonged consolidation and slowing returns for years, even as the technology itself thrives. The question is not whether the AI revolution is real, but whose capital will survive the infrastructure overbuild to profit from the mature sixth wave.